Michael Taylor here, professional trader and founder of Shifting Shares on Invest Engine's YouTube channel. And today we're diving into a question that every investor asks at some point. When is the best time to invest? And more importantly, should you go all in with a lump sum or spread it out over time using pound cost average? It's a debate as old as investing itself, so let's break it down. Before we get into lump sum versus pound cost averaging, let's start with a universal truth. Time in the market beats timing the market, and the longer your money stays invested, the more time it has to grow, thanks to the power of compounding. For example, £10,000 invested at an 8% annual return grows to over £46,000 in 20 years, £100,000 in 30 years, and nearly £217,000 in 40 years. The earlier you start, the better, but how you invest that money, either all at once or gradually, can make a big difference too. And lump sum investing means you invest all of your available funds at once. So let's say you inherit £50,000 or sell a property. With lump sum investing, you put that entire amount into the market straight away. So why is lump sum often considered the better option? Well, here's why. Research shows that lump sum investing outperforms pound cost averaging around 60% of the time over a 10-year period. And this makes sense because markets tend to rise over the long term. By investing up front, your money has more time to grow. You also get reduced cash drag because holding onto cash while you slowly invest it through pound cost averaging means part of your portfolio isn't earning market returns. And with lump sum, every penny is working for you from day one. Plus, lump sum investing is straightforward. You don't need to worry about scheduling monthly contributions or tracking your investments over time. You can definitely add more later on, but as we've seen, statistically, it's better to get started. But lump sum investing isn't without risks, so if you invest a lump sum just before a market crash, you'll face immediate losses. For example, someone who invested £100,000 in early 2008 would have seen their portfolio drop by more than 30% during the global financial crisis. There's also psychological pressure because seeing a large investment decline can be emotionally taxing. Some investors panic and sell, locking in their losses, and investing isn't just about numbers, it's also about managing your emotions. Now let's talk about pound cost averaging. So with pound cost averaging, you spread your investment over time, investing a fixed amount at regular intervals regardless of market conditions. And pound cost averaging has some clear advantages because by investing gradually, you avoid the risk of putting all your money into the market at a peak. And this is a less stressful way to invest, putting in smaller amounts over time rather than a large lump sum. And pound cost averaging can help you avoid the paralysis of waiting for the perfect time to invest. Pound cost averaging also encourages regular investing, which is a good habit when aiming to build wealth over the long term. But pound cost averaging isn't perfect. You are likely to get lower returns in rising markets. And since markets generally rise over time, delaying your investments with pound cost averaging means you're missing out on potential gains. Remember, research shows pound cost averaging underperforms lump sum in 2/3 of cases. And we looked at cash drag too, because with lump sum, the uninvested portion of your money isn't growing, and this can significantly impact returns, especially over longer periods. So let's look at the data. Vanguard's study compared lump sum and DCA across multiple markets, including the US, UK, and Australia, and lump sum outperformed DCA 67% of the time over rolling 10-year periods. However, during market downturns, DCA offered better downside protection. Another study by Morningstar found similar results, with lump sum delivering higher average returns, but DCA being less volatile. So the key takeaway here is that lump sum is statistically better for long-term growth, but DCA can help reduce risk and emotional stress. And my view is that if you're invested for the long term, then short-term volatility shouldn't matter. But everyone's different and has their own situations and their own circumstances. So how do you choose between lump sum and pound cost averaging? Well, here are some key factors to consider. If the market has just had a significant drop, lump sum investing might make more sense so long as you aren't worried about the market falling further. And if markets are near all-time highs, pound cost averaging could help mitigate the risk of a correction. But again, you are likely to be worse off in the long run, and it's also nearly impossible to predict when the market has topped out or bottomed. So for this reason, trying to time the market is generally advised against. And if you are comfortable with volatility and can stick to your plan during drawdowns, then lump sum investing could be right for you. And if you are more risk averse, then pound cost averaging might provide peace of mind. Finally, the longer your investment horizon, the less timing matters. So over 20 or 30 years, the differences between lump sum and pound cost averaging are going to be minimal. What actually matters is starting your investment journey, because at the end of the day, the best time to invest is as soon as you can. And whether you choose lump sum or pound cost averaging, the most important thing is to get started and stick to your plan. Remember, investing is a long-term game, and staying disciplined really is the key to success. And remember, with Invest Engine, you can open a stocks and shares ISA completely free and get started with their range of ETFs. Invest Engine is built with long-term investing in mind, so it is an ideal place if you want to take a slow and steady approach. They also have a number of fee-free options, so you can keep more of those returns over the long run. Please also remember that capital is at risk when investing, and none of this video should be considered investment advice, and that if you are unsure, you should seek a regulated professional. Let me know in the comments, do you prefer lump sum or pound cost averaging? Because I'd love to hear your thoughts.